Hey Tara, I know you had some questions about depreciation, so I thought it would be easier rather than typing this out in an email to just sort of talk you through some things. So first, I want to say that adjusting entries are still journal entries, but they happen because time happened. So as time goes by, certain things occur that don't automatically create a journal entry, a transaction for them, but we need to account for them. So we want our expenses and our revenues to be recorded in the same time period in which they were either used, if it's an expense, or earned, if it's a revenue. So when we look at things like supplies, if I use supplies in January, at the end of January, I'm going to debit an expense to supplies expense. That will increase my expense while decreasing my equity. And I'm going to credit supplies because I no longer have my asset supplies on hand. I don't want them showing up on my balance sheet. The same holds true for any other thing that I use. Depreciation is different. So if I look at my supplies, I can say, yep, I use them. I can see that they're no longer on hand. I open up the cabinet, there is less supplies than what I had. How much did I use? And then I expense however much I used. For long-term assets like truck, building, equipment, fixtures, furniture, anything that lasts longer than 1 year, I still want to be able to say, hey, I used this truck. I used this building. I want to be able to take that expense. And the way we're able to do that on something that we haven't completely used up is by recording depreciation. So if you remember, an expense is us saying I used. I have utilities expense, I used the electricity. I have salaries expense, I used my employees. I used their time, their knowledge, their expertise. Right? So whenever I say I have an expense, it's because I used whatever the thing is that I used. For depreciation, we're going to only use part of whatever the asset is. So when I look at, in this case, we paid $54,000 for computers. They'll remain useful for 3 years, and we expect them to be worth nothing. So our residual value, or you might hear sometimes salvage value, is 0. That just means if I have a truck that I'm going to use for 7 years and I think I can sell it at the end of 7 years and get $2,000, that residual value that I think I can sell it for will not be depreciated. That's why we say it's the cost minus whatever that residual value is. In this case, it's 0. So I have $54,000. So let's do this. Straight line is cost minus residual divided by useful life. And I'm going to say in years because there are other formulas that are the same, cost minus residual divided by useful life, but it's not in years, it's in something else. So for us, the cost is $54,000 minus nothing divided by our 3 years. And what does that give us? I don't have my calculator in front of me. That's going to give us 18,000. 18,000 is our depreciation expense per year because we divided by 3 years. So this is per year. That's what that, oh my goodness. Trust me when I say this says year. But only 1 month went by, right? We want depreciation for May. We only want 1 month. We can't depreciate for the entire 18,000 because we didn't have this asset for a whole year yet. We can only depreciate how much we used it. We used it for 1 month. So we'll divide by 12, and that will give us $1,500. And this is per month. Now, there are 2 rules for adjusting entries. Adjusting entries will never, ever, ever, ever involve cash. So I know I'm not going to debit or credit cash whenever I'm doing an adjusting entry. That's rule 1. Rule 2 says I'm increasing either a revenue or an expense. So I'm either going to debit an expense, because that's how it increases, or I will credit a revenue, because that's how that increases. And the way you determine that is you say to yourself, okay, in this instance, whatever I'm talking about, did I use or did I earn? Well, this is computer equipment, so I used it. So I know I'm going to debit an expense. What expense am I going to debit? Well, it's depreciation. So this was on May 31. I'm going to debit DEPRECIATION expense. And it's for the 1 month, so it's $1,500. So I followed the 2 rules. I don't have cash, and I debited an expense, and I'm not going to also credit a revenue. It's either or. It's not going to be both, ever. This depreciation expense affects my income statement. Whatever I do for the other thing is going to affect the balance sheet. And I'm saying in that way because if this was a credit to revenue, the credit to revenue would affect my income statement, and whatever I'm debiting would be affecting my balance sheet. So because this is my income statement part, now whatever I do here is going to be either an asset or a liability. Well, what did I expense? In this case, I expensed part of my computer equipment. But I know from chapter 1 that my computer equipment needs to be on my books at whatever I paid for it, which in this case is $54,000. I cannot change that. It needs to stay on the books at cost. So, in order to say, well, the value of this equipment that I've used has decreased because I used some of it, we put that into our accumulated depreciation account. So I'm going to credit accumulated DEPRECIATION, and I have to name the asset. So I'm going to put a hyphen, computers. And I'm going to credit for the $1,500. This accumulated depreciation hyphen computers is an asset account. However, it is a contra asset account. So any contra account is attached to something and runs contrary or opposite to whatever it's attached to, which is why I have to name it. In the depreciation expense, I know in Pearson it's going to say hyphen computers or computer equipment or whatever it is. I don't need that, and we'll learn that in chapter 4. The depreciation expense, I just need to say it's an expense. But on the accumulated account, which is a contra asset account, I need to say it's attached to computers. So this contra account reduces the book value of whatever it's attached to, in this case, computers. So let's look at what they actually want. Calculate the amount of depreciation for the month of May. I did that. For the month of May is $1,500. 2, record the adjusting entry, May 31st. Here's my adjusting entry. I know that there's no cash involved, and I'm either going to debit an expense or credit a revenue, and I did that. So every time I do an adjusting entry, I want to look at it and make sure I followed both of those rules. So that's requirement 2. Requirement 3 says, post the purchase of May 1 and depreciation on May 31st to T accounts for computer equipment accumulated and depreciation expense. Show their balances. So I need 3 T accounts. But here's the thing. When I'm doing journal entries, this is an official transaction. This is a document that is official and can be audited. I cannot abbreviate anything. T accounts, on the other hand, are just shorthand for me, so I can call them whatever I want as long as whoever's looking at it knows what it is. So I'm going to say, here's my computers. Here's my computer, no, because it's depreciation expense was the next one they wanted. Depreciation expense, and then I want accumulated depreciation, and I'm still going to say computer because I may have many other accumulated depreciation accounts. I may have accumulated depreciation truck, and that has its own T account because that's attached to the truck. I might have accumulated depreciation equipment, and that's attached to the equipment, and going on forever. So computers, the only thing that's in there is I purchased equipment for $54,000. The balance is $54,000. For depreciation expense, I did a debit of $1,500, so I have a debit of $1,500 and then nothing else, so my balance is $1,500. For the accumulated account, the only thing I did was a credit of $1,500, so my balance is $1,500. Part 3 said, oh, sorry, that was part 3. Part 4 says, what is the computer equipment's book value? Okay. Book value is cost minus the accumulated account. So my cost is $54,000 minus the balance in my accumulated account of $1,500. So 54 minus 15 is what, 52.5? Did I do that right in my head? I think so. But here's the thing. So this is the book value at the end of May. In the end of the next month in June, I'm going to do this exact same journal entry again. I'm going to do June 30th, debit depreciation expense, 15, credit accumulated depreciation hyphen computers for the same 15, and that is going to change this account. I'm going to have another $1,500 in here, which means now my balance in the accumulated is $3,000. So at the end of June, my book value is still cost, $54,000 minus $3,000, which means my book value is decreasing. So now my book value, what is that, $51,000. As my accumulated account increases, my book value decreases. And I'm going to do this $1,500 every single month until I get down to my residual value, which in this case is 0. And when I look at this on, hang on one second while I break out